So central bank digital currency will be in your central bank digital wallet on your phone or whatever device you happen to own. And what that means is, because of the limit, if you've got 3,000 euros limit, if more money arrives in your digital wallet than the limit, it'll automatically be swept into your bank account. And if you want to load your digital wallet, you'll move money from your bank account to your digital wallet at a 1-to-1 rate. One bank dollar is equal to one digital dollar. Same thing, or so it will seem to most people, just like 100 cents seem. Let's just have a look at how gold has been performing versus government debt. So government debt has expanded massively over the decades. Since 1971, government debt, this is the USA, has increased from $389 billion to around $37 trillion today. That's nearly 100 times as much. And if you look at this chart, on the chart here, you can see the government debt, which is the green area chart at the bottom with a yellow line at the top. And you can see the government debt's been increasing fairly constantly year after year, sometimes a little bit faster, sometimes a bit slower, and it's starting to increase a little bit faster, and it's likely to accelerate away from here, mainly due to the fact that the interest burden is becoming more and more important. Because back in 1971, which is here on the chart, in 1971, the debt to GDP ratio was only 25%. In other words, the total debt of the United States was 25% of their GDP. It was quite manageable. Today, we're at around roughly 100% debt to GDP ratio. It's 4 times as much. In other words, compared to the economy, it's 4 times larger than it was in 1971. And the debt is as big as the entire economy itself. And the Congressional Budget Office predicts that debt to GDP ratio is going to continue to rise. And obviously it can't rise ad infinitum, because sooner or later something will go wrong. It always has in every country in the world where debt has become too burdensome. And on this chart, I'll just adjust it slightly there. On this chart, you can see the green area is the government debt, and the red line is the gold price. Both of these are on a logarithmic scale. So on the left-hand side, we've got the log scale for government debt, and on the right-hand side, we've got the gold price in dollars, also a log scale. And I've drawn a blue line, a straight line here, which roughly matches the past growth in government debt. If it were to continue at the same pace, and I stress that a lot of people think it will accelerate at a faster pace, me included, but if it continues at the same pace, we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. And by 2050, $50,000. Now, I don't seriously think we're going to get to these high numbers, because I think the currency something's going to happen to the currency before then, whether it's replaced by a new currency or there's a complete failure or a spiral out of control, I don't know. But my feeling is something's going to go wrong before we get to 2050 and see $50,000 gold price. But anything is possible. So be prepared for the unexpected too.
Over the last 20 years, major economies have dramatically expanded their money supply to stimulate growth and stabilize financial crises. Yet every surge in liquidity has been echoed by a rise in gold prices, reinforcing gold's role as a barometer of monetary excess. Even in periods when inflation retreated, the long-term trend of gold followed the upward march of M2. As economists warn that deficits will continue accelerating, especially with rising interest rates draining government budgets, gold appears to be tracking the structural weakening of money itself. History shows that once trust erodes, financial systems rarely reverse course smoothly.
Let's just have a look at the increase in government debt compared with money supply. Now, this is a bit of a more recent chart. It goes from 2004 to, where are we today? 2000, yeah, it goes from 2004 to 2025. That's it. It goes up to July, in fact. And here you can see the red line is the M2 money supply of the G20 countries. The scale is on the left-hand side, is a logarithmic scale. At the bottom it's 15 trillion. I should have put the figure in there. And 15 trillion, I think it's trillions. And on the right-hand side, you can see the gold price, which again, I'll just shrink that a little bit, to show you here. Yeah, on the right-hand side, you see the gold price rising from roughly $400 to around $4,000 over the period. So the gold price is keeping pace with the expansion of money supply, it's keeping pace with the expansion of government debt, and those trends, which are almost looking like they're straight line or accelerating, they're not likely to go down, and probably the gold price will continue to keep pace with the rise in debt and money supply. That's what they've tended to do in the past, what gold's tended to do in the past, and probably what it's going to do in the future. So one of the big problems with US government debt is the interest on that debt. Because the level of debt has risen as a percentage of GDP, so has the interest burden as a percentage of GDP, and we're in a higher interest rate environment than we've been in for the last 15 or 20 years. So currently, the interest being charged or having to be paid on national debt is increasing at quite a fast rate. So in 2021, the interest on the US national debt amounted to $352 billion. That's the figure from the Congressional Budget Office. To $352 billion in 21. 3 years later, in 2024, it was more than double at $881 billion. So it's gone from 352 to 881 billion in 3 years. And the interest burden is going to keep rising according to the Congressional Budget Office, their own numbers. It could be worse than they expect. The Congressional Budget Office is forecasting that the US government debt owned by the public will reach 120% of GDP within a decade, and it might go faster than that. When debt burdens rise, history suggests several possible outcomes: higher inflation, restructuring, or some form of capital control. All of these scenarios, if they occur, have historically been supportive of gold. I think that one of these scenarios is likely. Now, let's turn to what's going on with portfolio managers and their asset allocation.
The most alarming shift today isn't just the size of government debt, but the cost of maintaining it. Over a few short years, U.S. interest payments have more than doubled, overtaking defense spending and approaching the scale of major social programs. Higher rates worsen the cycle. More borrowing leads to higher interest, which requires even more borrowing. Analysts warn that if this continues, debt to GDP levels could surpass historical danger zones cited in past sovereign crises. When nations reach this point, outcomes have historically included high inflation, currency resets, and aggressive financial controls, all scenarios that push investors toward gold.
We know that portfolios have very little gold in them. It's somewhere in the range of 0 to 1 or 0 to 2%. And most portfolios have no gold at all. But this now appears to be shifting. Some banks and some institutions are starting to come out and say that portfolios should hold a little gold. And hats off to Morgan Stanley. Their chief investment officer favors a 60-20-20 portfolio strategy, with gold as an inflation hedge. So basically, he's looking at moving from the traditional 60-40 approach in equities and bonds to a 60-20-20 approach, where gold is one of those 20s and replaces half of the bonds. Another bank which has started to recommend gold, and there are a few others, is Standard Chartered. Ray Dalio, you may have seen, has come out and said that investors should have 15% of their portfolio in gold. Whatever the correct figure is, it's clear that the current level of between 0 and 2% is just too little. It's not going to move the needle at that level. You need at least 5%, and 15 or 20% would be a more sensible number. So even if a very small percentage of global assets, that's bonds and equities, rebalances into gold, and there's 300 trillion of these assets out there, it would absorb the entire year's mining supply. How much would have to deviate from those assets into gold? 0.1%, 0.17% would absorb the entirety of the gold mine's annual production. Put it another way, that's 1 part in 600, 1 in 600 of the amount of money in assets related to gold, related to stocks and bonds. So if institutional money starts to flow into these assets, the gold price will move very quickly. Now, if you're considering buying physical gold, one option that I'd like to help try and make it easier for you is my affiliate, which is Gold Bullion Partners in the UK. They provide physical gold, competitive pricing, and you can speak to them on the telephone number below this video. If you have any doubt, look at the Google reviews on Google and you'll see what the Google reviews have got to say. I'm just pointing them out there. It's all 5-star. 104 reviews I see today. That's Gold Bullion Partners in the UK. And you can speak to them for absolutely free of charge on the telephone number below this video. Now, we've got central banks accumulating gold at a record pace.
For decades, institutional investors largely ignored gold, relegating it to a negligible percentage of global portfolios. But that era is quietly ending. Major banks and investment strategists now recommend allocations far above previous norms, citing gold's rising strategic importance in unstable monetary environments. Even a fractional rebalancing, less than 0.25%, from the $300 trillion global asset pool into gold would overwhelm annual mine supply. As pension funds, sovereign wealth funds, and asset managers look for protection against inflation and geopolitical risk, gold's role is shifting from optional hedge to essential insurance.
They're buying more than 1,000 tons a year for the last 3 years. And the high prices, the record prices, are just not deterring them. And let's face it, after all, they can print money as much as they like, so why would they care if the price is at an all-time record? They don't care, they just want more. So why do they want more? Why are they buying? Well, they want to diversify away from the dollar, they're hedging inflation, they're preparing for geopolitical risk, and they're increasing their resilience against unforeseen events in the world markets. And who's leading the purchases? Well, we know that mostly the big buyers are the emerging markets. They're countries like China, Turkey, India, Poland, and Kazakhstan, for example. And surveys are showing that around 81% of the emerging market reserve managers expect to increase their official gold reserves over the next 5 years. You can find the results of that survey on the World Gold Council website. Recently, we've seen places like China and Japan effectively reduce their exposure to government bonds, US government bonds, that is, Treasury bonds, as a percentage of their GDP. So as their GDP and the US's GDP has gone up, their exposure to gold has increased and the exposure to government bonds has effectively been decreasing. And of course, we've seen on COMEX unusually large deliveries this year. We don't know who is taking delivery because that's secret stuff, but someone somewhere is taking a lot of gold.
While investors debate, central banks are acting decisively. Nations across Asia, Eastern Europe, and emerging markets are accumulating gold at the fastest pace in modern history, often exceeding 1,000 tons annually. High prices have not slowed them. They print their own currency, making cost irrelevant. Their motives are clear: reduce dependence on the US dollar, strengthen reserves, and prepare for financial disruptions that may reshape global trade and power structures. Simultaneously, foreign holdings of US debt are declining, signaling a strategic shift. Large, undeclared gold withdrawals from exchanges hint that quiet accumulation may be even larger than reported.
Now, let's move to a more worrying aspect. I'm going to talk about the digital euro, which is about to arrive. The digital euro will be going live next year and will be full-blown by 2027. Now, we all know about some of the dangers of the digital euro, surveillance, controls, but this is not really what I'm talking about here. Obviously, this is a very sensitive matter, so I might use some cautious words like "I think it may," but I think the reality is rather fearful. I rather fear the output. So let's start with the point that digital euros are not the same as the euros in your bank account. The central bank digital euros are a direct liability of the central bank. They're not the euros which have been created by your bank in a roundabout way and are a liability of your bank. Now, when your digital wallet arrives and you start using it, you'll find there's going to be a limit. The limit is expected to be around 3,000 euros. That's the maximum you'll be able to put into it. And there's a good reason for that. The rush into the digital euro, and it will probably be a rush because everyone will get their digital wallet and effectively at some point be told they've got no choice but to use digital euros. That rush into the digital euro will effectively be taking money out of the banks. Now, some studies are estimating that 10% of deposits could migrate into the digital euro. Now, I'm going to be frank, the banks can't handle a move of that size, especially not the smaller banks, which are dealing with retail customers who usually have very small balances. So if all these small balances move out into the digital wallet, as is likely, these smaller banks, I'm going to be polite and say they might face pressure. Well, face pressure, they're going to face more than pressure, insolvency, because they'll have a problem. They've lent money long-term on mortgages and car loans and things like that, and everyone wants their money back, and it's going to be very hard to lay their hands on money. So, of course, you would say, well, that's no problem. They can borrow from the big banks who don't suffer from the retail customers so much. Yeah, so maybe, but I think the same thing will happen as happened in 2008. Every bank will be reticent about lending to another bank because they won't know who they can trust. So it's quite likely that we will run into some sort of crisis. And it's not like the ECB doesn't know that this is a real danger. They accept it. I mean, they don't know it will be a danger because they don't know how much money will move into the digital wallets. I'm assuming here that a lot of retail investors will load up their digital wallet with everything they've got in their bank account because the digital wallet is going to be free and the bank account often is not, or the digital wallet might offer some interest rate which is attractive. So the ECB knows for sure that this danger could happen. People start emptying their bank accounts in favour of the digital wallet, at least up to the limit of 3,000 euros, and smaller banks could be in trouble. So what they will be doing is what's called tiered remuneration, which means they can offer you a variable interest rate depending on your balance to try and drive your behavior. So if they want you to put money back into your bank because your bank's suffering because money's going out, they could effectively offer you either a very low or probably a negative interest rate to ensure that you don't keep your money there and move it back to the bank. But they'll have a lot of control over what you do with your money and how. But later on, what's coming for sure is a rule which will say all transactions have to be by your central bank digital wallet. So central bank digital currency will be in your central bank digital wallet on your phone or whatever device you happen to own. And what that means is, because of the limit, if you've got 3,000 euros limit, if more money arrives in your digital wallet than the limit, it'll automatically be swept into your bank account. And if you want to load your digital wallet, you'll move money from your bank account to your digital wallet at a 1-to-1 rate. One bank dollar is equal to one digital dollar. Same thing, or so it will seem to most people, just like 100 cents seem like a dollar to most people. And that will be the case initially, that you'll be able to move money freely from one to the other, provided you stay within the limit and don't go above that 3,000 euros. But they will say every transaction has to be via your digital wallet so that they can check you for money laundering, for terrorist activity, for tax evasion, and other undesirable things, like perhaps going to a protest or perhaps actions which don't support the government in power. Who knows? So I haven't even got to the scary bit yet, so please stay tuned.
The looming introduction of the digital euro marks a major turning point. Unlike bank deposits, digital euros are direct liabilities of the central bank, giving authorities unprecedented visibility and control over transactions. While initially capped, the shift of deposits into digital wallets risks destabilizing smaller banks, which depend on customer deposits to fund loans. In response, policymakers plan to manage behavior through variable interest rates and mandatory use of digital wallets for transactions. Critics warn that this framework could lead to sweeping financial oversight, automatic fund movements, and a future where personal autonomy over money becomes increasingly limited.